This is a company with a market cap of 80 million. And what I learned is that, as I said, the money in public markets over the last 5-10 years, it went to the indices. Now, 75% of the world's capital in the public markets and the equity markets is basically passive, so index or index-like, and this tends to go then to kind of big tech. Even like a somewhat medium-sized equity fund, to buy a company with a market cap of 80 million or to buy into it needs a lot of work. And then what's the minimum ticket size? It means liquidity risk, right? Small caps tend to be more volatile, and nobody wants to do it. So a lot of the family offices that I speak to are personal investors. They don't like volatility. They don't like small caps. They're rather just buying the large caps. They're buying tech stuff that really works.
Welcome everybody to another Europreneur Podcast from EO Europe. My name is Nir Zavaro, your host as always. And today I have another guest on the mini-series we're doing about the Zurich chapter and introducing some of their amazing, fabulous members. And today I have Robert with me. How's it going, my friend?
It's great. Thanks, Nir. Thanks for having me. It's really a pleasure to be here.
It's my pleasure to have you. And, I have to say, you're very Swiss. I got an outline of what we're going to talk about and how it's going to be. And I have to say, I've done 50 episodes and you're the first one that came more prepared than anyone else. So hats off to you for that. Do you usually do podcasts?
No, actually, I don't. I try to be this discreet and working behind the scenes, but EO is a great community. I really like it, and I thought this is a great platform. So happy to share some knowledge and speak to the community.
How long have you been an EO member?
About 10 years.
Ah, amazing. So even longer than I am. So let's jump into it. Can you share a little bit about who you are, what you do, what's your business, and we'll deep dive from there?
Yeah, sure. So what I do is I manage an investment fund that primarily caters to friends and family, but also a few family offices. And what I do is I invest in public equities, but in a very concentrated and selective way. So I typically hold about 10 positions. I invest in small caps, so stocks that are outside the large indices, often overlooked. I consider them undervalued, unappreciated. And I also co-invest with entrepreneurs. So I pay a lot of attention to partnering up with entrepreneurs running great businesses, small businesses in the public domain outside kind of the major headlines.
What would be a public domain, if you can elaborate?
Yeah, so I mean, what I mean is public domain, publicly listed stocks, so stocks that are listed on an exchange. There are about 50,000 stocks out there that are listed, and then I try to pick 10. And when I think the last few years they were a bit odd when people talk about in the EO sphere, they often talk about venture capital. They talk about private equity. So this is private and off the market. And then when they talk about public markets, they talk about maybe the next hot tech company. They talk about the FANG stocks. But there's a universe of smaller businesses in traditional industries. And there's some really great work that's being done by entrepreneurs like you and me. And I'm trying to tap into this opportunity set and find kind of the hidden gems and have a great time.
Listen, I do marketing, okay? I do storytelling. How do you? What's your journey that this is what you do for a living? How did you start this?
Sure. So I studied business, and then what do you do after business? You start banking or consulting.
In Switzerland.
In Switzerland, right? So I joined the consulting business and I traveled kind of Europe restructuring companies. This was after September 11 and the dot-com crash. And we really picked up whatever industries had collapsed in those turbulent times. And some of our clients were investment banks like Goldman Sachs, where they bought debt of companies that were failing. And they bought the debt at a discount and converted the debt into equity, controlled then the company and restructured the company. So from being a consultant, I had the opportunity to go to Goldman, where I helped manage a bit of Goldman's own money. And we kind of tried, as I said, to to buy debt on the cheap and kind of restructure the companies that we then owned And this was a great experience to learn from. I did the same for another hedge fund. And, eventually I thought, okay, I want to do this on my own. I want to build my own track record. Now, when you're smaller and not part of an institutional group, the equity markets are just probably the easiest playground to work with. Because as I said, you have 50,000 companies, they're listed. That means all the information's out there. You can screen the companies, you have quarterly reports, and it's actually really easy to look at the opportunity set and then pick, 10 great companies that are hopefully undervalued.
I love the fact that you use the word easy.
It's easy in the sense that proper valuation work is probably not that difficult, but what makes investing hard is the psychological aspect. What I would say though is that, as I said in the intro, the last 10 years have been quite interesting and a bit weird because there was an abundance of capital. We had 0% interest rates, and a lot of the people in my environments, entrepreneurs, and also people on the buy side, they're really focused on venture capital or, hot tech companies. And I think there's a generation out there that never probably learned like the old school valuation techniques where you're looking at assets, replacement values, at cash flows. And I think we all learned to pay up for like a nice story, a nice narrative. But, maybe times are becoming a bit more normal again. And as I said, there are so many traditional businesses out there where companies are providing a crucial service to society. They have real assets and they're trading at 2 to 5 times cash flow. And, not too many people that I speak to are actually trying to really tap into this opportunity set. And, the interesting thing is I talked a bit kind of venture capital and private equity as competing with what I do. When people talk about public markets, they talk about the index, they talk about big tech, but they don't talk about all these small caps. And I'm just trying to kind of create a bit of excitement and awareness that there's a whole world out there of capable entrepreneurs in the capital markets, and often these companies are undervalued.
It's interesting. I think in many ways people start to use the word startup to be able to just invest a shit ton of money without anything behind it. So a good story and everybody gets a hype, and this will be we're a disruptive company in the market, so you have to give us 100 million. Whereas what you're talking about is what we refer to as a real business that actually has not just assets, but actually a revenue and a business model.
Yeah, it's like it's proven. Yeah, it's making money actually.
But I want to take you, if it's okay, and again, I'm not from this industry, so bear with me. Let's go back a little bit. You were working at Goldman Sachs. There's one thing about going and saying, okay, I'll buy the debt for a big discount, but it's a completely different game to turn that into a profit thing.
Well, yes and no. I mean, I think that the skill set is the same because there are 2 layers of valuation. So the first thing that you look at is like, what do I actually buy? And they're tangible assets. So for example, a company that owns real estate and, you could kind of buy the real estate and then sell the real estate and there's some proceeds. Or a company has a product, machinery, and they're selling a product that makes money, right? So that's a going concern. So you're looking at the liquidation value, or you're looking at what is this business worth when, you just continue to run it. You also look, I spend a lot of time looking at can we cut costs, right? Some of the parts valuation. So if you have a company that is producing 3 products, 2 are profitable, 1 is loss-making, right? What happens if you just cut off the loss-making product? And then there's a more technical aspect where often you have different parts of ownerships, right? So you have maybe senior debt, you have junior debt, you have preferred equity, you have common equity, you might have even options. And then it's speaking and negotiating with all the different stakeholders and see like where's the value, right? And one thing that I learned is also that if you look at a business, right, it's about probabilities. So you might be able to sign a high probability for a business to have a value of at least $1 million, but then, paying 5 or 10 million, that becomes more risky. And then how do you price this?
But you mentioned they have 2 profitable products, one's a loss.
Right.
Then who's going to fix that? Who's going to be on the ground? Like when you buy the debt, you not just buy the brick and mortar.
Correct.
Right? You also buy people. How do you then go to that person that you just acquired their company and say, we just hostile took over and we'll help you fix it? Is it a friendly thing? Do you like, how does it work?
Well, in my previous job, we would have looked at maybe the management team, and then it's like, can we fix it with the current management team? And often you have actually capable people, but they are constrained because of other issues like politics or a quarrel among the owners or so. Or do we need to replace the management team? Do we have to get somebody else in, right? And this is what we would have done, and in trying to increase the value of, and you can do this maybe by having a larger stake, and then suddenly there's a shareholder that has a say, maybe somebody who doesn't shy conflict, somebody who has a network of other managers and so on. What I do now is a bit different. What I learned over the last 20 years since I've been doing this is it's actually easier to partner with companies that are well run. It's kind of like what Warren Buffett would do. So I'm trying to find small businesses run by entrepreneurs, so by people who are business builders, people who have a lot of skin in the game, who earned their stake, so it wasn't given to them. And then just, try to support them. So first of all, obviously, it's like trying to pick up a gem that's overlooked for whatever reasons, buying it cheap or undervalued. But then also trying to help those entrepreneurs by, not telling them how to run the business, but by just advising them. I mean, I would say that, I'm a provider of capital, and I'm also a provider of, let's call it more financial advice. So capital allocation, how to manage a balance sheet, maybe. I can maybe bring in other partners.
Can you give me can you give an example where you go in, you buy this, what you believe is a potential, and you find a struggle with explaining to the owners about why your advisory in that section of finance is so crucial? They don't get it, or at the beginning they're reluctant to work with you. An example like that, maybe?
Yeah, no, sure. I can give you actually two examples of the same story, very different kind of cases. So the first case is the business that was very small and grew, and it took a long time for the business to gain traction. But over the last 3 years, suddenly the work of the previous 10 years suddenly bore fruit, and the company became very profitable in a very short period of time. And what happens now is that this company is accruing cash at a very fast rate. And it's run by an entrepreneur who built it, but he's almost overwhelmed now by the success of, a long time where he actually was laboring and trying to make this work. And, it's overlooked. I think it's very undervalued, trading at a PE, so an earnings ratio of 3, and it has a lot of cash. So I bought a big stake. And I'm trying to help the current management team and also other shareholders to find the best use of the cash. So we want to grow the company. We think there's a great potential to grow. But on the other hand, the company can't grow as fast as they accrue in cash. So it's like, okay, so we want to grow. So we park some of the cash for growth. And with the other cash, what do we do? Do we pay out dividends? Do we buy back the shares, right? And they're just like we are running through different options. Also, the balance sheet is almost underutilized now. What can we do? So a few questions, right? So very successful business, but I think it needs a bit of guidance and advice as to how suddenly cope with success. It's a great position to be in.
Why would someone sell a successful cow milking business? Or how do you explain to them that it's in their best interest to sell it? Did they take money off the table? Is that?
No, so it's a very good question. So it's a listed company, so it's on a stock exchange. Management owns a part, but there's quite a few of the shares are just in the hands of retail investors and index funds. And so I'm buying from other investors. So I'm buying from, and the thing is, this is maybe going back to some structural issues. So this is a company with a market cap of 80 million. And what I learned is that, as I said, the money in public markets over the last 5-10 years, it went to the indices. Now 75% of the world's capital in the public markets and the equity markets is basically passive, so index or index-like. And this tends to go then to kind of big tech. And, even like a somewhat medium-sized equity fund, to buy a company with a market cap of 80 million or to buy into it, needs a lot of work. And then what's the minimum ticket size? It means liquidity risk, right? Small caps tend to be more volatile and nobody wants to do it. So a lot of the family offices that I speak to are personal investors. They don't like volatility. They don't like small caps. They're rather just buying the large caps. They're buying tech, stuff that really worked, right? Which provides opportunity for me. So in this case, you have a small company that's not part of the index. So a lot of the capital doesn't even find them. They're very small funds that, it's a business that requires some attention. You need to understand it and you need to kind of speak to management. It takes some time. It's not difficult, but it takes time. And there are not that many people that are actually wanting to do this or that are spending the time to do it. And this provides opportunity. And so you don't have a seller as such, right? The seller, as I said, is more structural. It's passive money or small retail money. You might have a fund, and they sell for whatever reason. And it's just that, the opportunity is there because I think it's misunderstood. It's small. It's not part of the big indices. And I see a ton of these opportunities.
In many podcasts that we've done with EO members, we talk about the difference between being the entrepreneur, the idea person, the one building, the visionary at the beginning. And then when the business starts to evolve and change, and then at a certain point, you're dealing with a whole new set of issues or problems. And I assume that's when you need to start rethinking about how you look at finance. Am I correct?
Yeah, absolutely. And like you said, I think when you're starting out, you're very focused just on the first product, right? On hiring your first 5, 10, 20 people, on whatever, building just the machinery or like your IT systems, doing a marketing strategy. But then eventually, if you're running a company in the capital markets, you need investor relations, you need to constantly maybe speak to the capital market, right? You need to run, as I said, the balance sheet in a more conscious way. So if you're profitable, it's not just about kind of pitching and raising capital all the time. It's actually about maybe thinking about profits, about tax optimization. As I said, there might be a fight of like, what do you do with the profits, right? What I also see is when, the interesting thing is with startups and in the venture capital scene, you have money that understands you're spending money to build a product. But once a company is listed and they have a successful product, there's often a lot of greed to just distribute profits, right? And to really milk the company and the product. But if you want the company to grow, you might want to reinvest or you see another opportunity, but the capital market doesn't like this. So that's another point. I mean, the capital market, it's like so focused on the next quarter. And it's really, it can also be quite hard for management to spend money. And if they're trying to do something for like after the next 2 or 3 years, right? And this is also where I come in. I have patient capital and I have a community of patient capital behind me. And, if there's a company and they have a great product, but they're saying like, well, we want to invest and this means that we won't be profitable for 2 years, but we're building a business and it makes sense, right? The capital market might not like it, but, if it's credible and it makes sense, then I would jump in. And I'm backing them. I will help them to communicate this to the markets and so on.
But you still need to communicate back to the investors because they are listed to say, hey, we're thinking long term. So the share might still go down.
Yeah, the share price might still go down, right? In the end, it's like, are you comfortable with what you pay? I try to pay a low price to near-term free cash flow. So I think compared to like a lot of VC and private equity deals where you pay for a story and hopefully world domination in 10 years, I'm really disciplined and conservative. But as I said, small caps are very volatile. I can stomach it. Many others can't. It's about just making sure that the risk assessment that I do is correct. Right? You have to make sure that you're underwriting an idea with the right assumptions.
How many nights do you feel like you can't sleep well?
Actually, it's okay because, I need 2 ideas per year. I have 10 positions. I am a medium-term holder. I need 2 ideas. So I research them quite well. And obviously, there are always things where, they can go wrong and all these unknowns. But I think it's, you spend some time making an investment decision and you try to pay a price that you feel really comfortable with. And, you're protected on the downside just because you're not overpaying, right? And as I said, things always happen. But what also helps me is I'm close, right? I'm buying now larger stakes I can speak to other shareholders. I can speak to the management team. And all of this provides comfort and also conviction.
I want to take this to a bit of a different and leave the financial aspect for a second aside.
Sure.
But I love the fact that in order to make, as a business owner, to make 2 smart decisions a year, most of your time, I assume, or a big chunk of your time will go into learning the businesses, studying, looking at other options and saying this is not the right thing for various reasons.
Correct.
I feel that many of us forget the aspect of learning or reading. I know a lot of EO members are very big advocates. They consume a lot of content.
Yeah.
What would you suggest for young entrepreneurs as a means or ways of keep educated?
Educated. Great question. I think so. The first one is there's a lot of noise out there. I think we live in a world where there's an abundance of information and very kind of just shallow, short-term information. And I think a lot of people spend their time on social media, on Twitter and on LinkedIn. But if you think about it, a lot of this is just noise, right? And what I would encourage everybody is to look for information that provides a deeper insight. So not just look at like, I don't know, read the paper and get distracted by the headlines, but really like what drives industries, what drives trends. And so this is the first thing. Try to find literature that provides a deeper insight. Try to speak to people that have been working in an industry for 10, 20 years and really, pick the best assets, the best companies, the best teams, and really see what they're doing right and try to learn from them. The other thing is I would also say like what I learned is there's this halo effect, right? And also the survivorship bias. I think we live in a world where the winners of the last whatever weeks or months, they get all the attention, which is great. But those that were successful, they have this halo. Everybody's like, wow, they are amazing. But we fail to see all the ones that tried. Maybe they were more capable, but for whatever reason they failed. Just really try to get a sense for everybody who tried. Why did businesses fail, right? And so on. And the other thing is the halo effect. As I said, people who are successful often, we hang on their every word, but it's really, I really admire people who failed, who got up again, who tried again, and then who got lucky. I think a lot in life is just getting lucky. I do think that, you can kind of put yourself into situations where the chance of getting lucky is higher. But one should not confuse luck with with just skill and capability. And that is one thing maybe. And then, also look where others don't look. So in our EO network, right, there's a lot of IT right now. So there's a lot of focus on AI. But as I said, I do think we're in an environment where there's so many industries that are now overlooked, traditional industries. And of course, AI is going to be revolutionary and it will have a major impact on our life. And the cloud business has been, great for just every PC user. But at the same time, there's so many opportunities out there and they just don't make the headlines, right? Because it's a bit dull, it's a bit boring. And but this is where one can make a lot of money. And equally, there are like some really capable people. And it's interesting to learn from them.
What I'm hearing is luck is a big part if you put yourself in the right place to get lucky.
Correct.
And I think what people are missing is that part. In order to have luck, you have to put yourself in the right place.
I would say so.
And I think there's a woman called, I don't know if you follow on social media, some interesting people doing boring businesses. There's a woman called Cody Sanchez, which I've been following for the last, couple of years, I think. And she became very big on social media, and she talks about boring businesses. But what's interesting is, so she talks about buying a laundromat chain, fixing it, turning it into from a million to 10 million, and she talks about boring businesses. And I know a lot of people in those industries. So I always ask them, and they always say it doesn't work like that at all. Because if it would, we would build it. But what she showed, so it's always interesting about sometimes people talk about these things and it's a completely different thing in a different country. It works differently, tax-wise, operation-wise, and a lot of things. And I think when we see it on social, we say, yeah, I'll do it quickly, and we forget it's actually building a business.
There's another podcast, How I Built This, with Guy Raz. And when I listen to him, right, there's a common thread. So I think the ones that made it, they looked at a need and they tried to fulfill the need. I think all the entrepreneurs on his podcast, they suffered through a period of just rejection where, they were pitching the idea, trying to raise capital, and everybody thought this is stupid, this is crazy. And then in the end, it's just like finding a need, fulfilling the need, and just being obnoxious about, doing this. And then eventually, like, hopefully people get lucky, right? So those were a few takeaways from that I took away. But, so when I analyze businesses, it's the same, right? So I look at what the product that the business is selling or producing, right? Does it fulfill a need? And this also determines the pricing power, it determines the level of demand, right? That the TAM, and I look at, as I said, the entrepreneurs, are they just lucky riding a wave? Are they great at just pitching ideas and raising capital? Or, are they business builders? Can they create a good corporate culture? Can they motivate people? And, it's not difficult, but it's a very complex thing, right? Because in the end, it's all about people. It's about the people running the business. And as you said, it's, once you become a bit bigger as a business, it's not just about pitching an idea and constantly raising capital. It's about, processes, more factories, maybe entering different markets where the rules are different, and how do you handle this?
I'm hearing a very delicate balance using analysis, financial, how they spread the money and so on, in different technical terms. Mm-hmm. And then you say it's all about the people. How much of there's a diverse, you have a gut feeling where you meet someone, you say, this might be a good business, but that they're not the right people, and you walk away? Or how much is the numbers versus the feelings for you?
As I grow older, the feeling and the instinct becomes more important. So when I started out running my fund, I was very quantitatively driven. So I just looked at low financial metrics like EV, EBITDA, whatever, PE, cash to market cap. And, as I grew older, or as I've, now with my experience, I really look at the people. So I think certain industries attract, certain characters. I try to, I like to meet the people I invest in. People are so important. It's all about people.
Give me 1, 2, 3 red flags where you had some meetings and you said, no.
So I give you one just example where incentives actually can lead really capable and actually probably great people lead to do really stupid things. So there was a small tech business that was shrinking, but they were highly cash flow positive, and they were trading at cash. So here I am thinking, you have a shrinking tech business, but it's just spitting out cash, and it's trading at cash. And it was run by very intelligent and very eloquent people. I mean, you met them, right? And it's amazing, right? I walked away, it's like, this is perfect. And what did they do? They took all the cash and bought loss-making revenue. and the business basically collapsed 2 years later. I mean, I got out in time, but it was still painful. I did suffer loss. What had happened? So in their remuneration, they were paid on two things, one which was just revenue. And they decided, okay, if you just buy revenue, no matter whether it's good or bad revenue, it's good for our next paycheck. And this is, I think, a classic example where incentives and the wrong incentives can drive really bad outcomes. And so as I said, so I look at incentives, I look at how did people make money? In this case, they were employees. They were not the owners that had actually built the business. The original founders, in this case, they had stepped back. They basically had retired. And then when I spoke to them, they were as upset as I was. They were like, we built this business, we hired a new CEO, retired, and then all this stuff happened. So this was just one example, right? Where what looks undervalued or like attractive might not be because of the way people are incentivized and then how they allocate the capital or the value of the company.
Give me a good miss. Something you said, I'll walk away, and then you look back and you say, I should have done this.
So the miss is obviously some of the great tech names of the last, 15 years. So Apple, right? As I said, I tend to look at free cash flow and I don't like to pay up. So there was the iPod, right? I thought, okay, this is just music. Then they had the iPhone and I thought, okay, how big can this grow? And they were trading at 15 times cash flow, which, it's not massively high, but it's also not, dirt cheap. And I just underestimated, obviously, the platform. So those are the misses. Or Starbucks, right? So I traveled to the States in 97, and I saw Starbucks everywhere, but not in Europe. And I thought, I like it. Probably other Europeans like it too. It was obviously like a major growth stories even since 97 or so. Other business like Microsoft. So in 2008, Microsoft was actually value play. It was trading at 5 times cash flow. You might remember Steve Ballmer. He was a horrible CEO. Like when he entered the stage, it just looked horrible. But I thought, okay, everybody's using Office. And I thought, okay, Office is not going to go away. And Windows isn't going to go away. At 5 times cash flow, it's cheap. I sold it a few years later, just when it was trading at 10 times cash flow, and that's it. And then obviously, I missed the whole kind of run, right, once the cloud business developed and so on. And I think the lesson learned is what also you referred to, Nir, is quality, right? And actually looking beyond just the financial metrics. So really trying to understand the potential of the business. And as I said, I don't like to pay up. I don't like to pay up for a story and fantasy land. But if you have a great business, it's certainly worthwhile to pay up and really do the homework to assess whether business has a good growth runway or not.
It's interesting. Like I find that you don't know. Your gut feeling might save you sometimes, but it won't necessarily help you do the right thing. So it's always interesting to me. But I love the fact that going back to thinking about boring businesses or what we would actually define as a classic business. And I think people are so obsessed with building another AI, building another tech company, disruption and stuff, which I'm not saying that's a bad thing at all. What I'm saying, I think we're somewhat missing a huge way of thinking. Am I correct? That
yeah, and this is my this is my speech, right? And I give you another example. So, for example, in Australia, you have a listed law firm now, and it's trading at a P of 4, so 4 times earnings. It's trading at a fraction of the book equity value, which is capitalized work. It's 35% of book value, and it's run by founders. So you have 2 founders owning half of the company. Still, it's listed. And you can just buy the shares. The dividend yield is about 10%. And, this is an opportunity to become a partner in a leading law firm at what I consider a very attractive valuation. But, when was the last time you talked to one of your buddies about, how cool it is to invest in a listed law firm, right? And why not? So first of all, it's the same thing. It's small. So big funds don't go there. It's not in one of these large indices because even though it is Australia's largest law firm, it's still small compared to the overall size of the market. And it's a fairly simple business model, but it does take some time to, there are a few terms that you need to understand. You need to, you need to spend some work just trying to getting comfortable with just, how the business works. And then it's not sexy, maybe, right? So it's so much easier to talk about AI or cloud or cybersecurity. But as I said, this offers opportunity. And by the way, also this company, I mean, they're really happy to have loyal shareholders, and because they know it's hard to be a listed company in that field. And so it's a great learning from both sides.
The money you manage is just your money, or under the family offices you work with, or how does it work?
No, as I said, so it's friends and family plus a few family offices, and we're also expanding. I think this approach, so it's, I know every investor personally, and I do think there's a certain like-mindedness, and this is also where EO comes into play. So I think my investor base, they're mostly people who understand this approach, right? Who say like, okay, so we're buying real businesses run by great entrepreneurs at attractive valuations. And we are not overly concerned with where the share price is in the next quarter or in 6 months. And they are not kind of trying to just push this share price up to exit at whatever 10% gain. So I think we are a crowd with patient capital, and we are looking to build a nice portfolio, you might call a holding, of a few small niche businesses run by great people at very attractive values. And it kind of goes back to the early Buffett partnerships, really like how Buffett and Munger started out making their money. And what I've also seen in families that are really successful, right, and that really made it.
You have to send out a quarterly report to your investors, or that doesn't have? How does it work?
I mean, I don't have to, but I do to keep them entertained or to informed.
Is it informative or entertaining? That's important.
Both. Sorry, it's informative.
It should be entertaining. I can
and entertaining too. It shouldn't be too. It shouldn't be to try. Look, I think, what can I do, right? I can communicate my thinking so that people kind of get a feeling for how I think, whether that makes sense or not. And I do think that providing transparency, the companies that I invest in, I demand transparency from them. I want to have an open line of communication to my portfolio companies, and I try to have the same with my investors because we are partners, right? So for me, like, we are a club, a small community of like-minded people, and I want us to be very open. And this is also because, sometimes I make mistakes. Sometimes unfortunate things happen. I think nobody has this crystal ball. Nobody knows what might happen tomorrow. But, we try to do a good job. We communicate kind of why we do certain things. And this is why I have quarterly letters and calls. I would say a lesson learned from the last kind of 10, 15 years is sometimes as an investor, it's better to communicate less, just because, as I said, the frequency of information that's available to us these days often creates this urgency to do something, right? I mean, sometimes you wake up and then you see a headline, okay, there's something's happening here, something's happening there, and people feel like, okay, I have to do something, when actually the best thing is to not do anything, right?
Yeah.
So Charlie Munger calls it sit on your ass investing, excuse my language, right? So it's the money's in the waiting. If you pick a great company at a good price, you just lean back and you let it run. And you know what? Sometimes the share price goes up, sometimes it goes down, but over time, if in the majority of cases you get handsomely rewarded, you're doing really well. And, even like Microsoft or Amazon, even the great success stories of the last 10 years, the share price, that the average large cap has a huge volatility. So even, you can take McDonald's or Nestle, whatever, the 52-week high and the 52-week low, there's often a 30% gap. And, if you get nervous and trade too much, that's definitely not helpful.
I like it. I'll suggest something just for the fun of it as we're wrapping up.
Sure.
But what
Okay.
I do marketing. I listen to a lot of different podcasts and stuff. I assume you also, from what you said, are listening to a few.
For sure. Yeah.
And you said there's about 50,000 listed companies.
Yeah.
And I was, as you were talking now, what I'm thinking about is doing having you write a script and giving someone else to do it, and having someone completely different edit, not you. So it could be like every day, one company and you call it 1 out of 50. And it's every day an opportunity. And people are so eager to learn about these things, right? And they're so interested. And there's a lot of people who do quite well on social media where they create the content to talk about the company, what's interesting about the company and stuff. But they have on Fiverr someone doing the script, someone recording and editing, someone doing the voiceover. So it's completely not even you. But having and running a social channel like that would be very interesting for people.
Yeah, can I just say something? There are 3 people that I learned a lot from and that have surrounded a community each that is doing a bit what I'm doing. And if I can just mention them, and I think they would be quite happy for you to kind of talk to them. So first there's Guy Spear, who's a Zurich-based investor. And he's a great investor himself, but he has built a community called Value X, where we are a group of also like-minded people around the world. We have different meetings like in Zurich, in Dubai, in the States. And, we are all doing more or less the same, and I'm sure people would pitch ideas. There's another guy called John Mihaljevic, who's running the Manual of Ideas, probably a bit more institutionally oriented, but same thing, just pitching ideas. And lastly, Tilman Versch, Good Investing, who's kind of keeping the European, let's call it value investing scene together. And so it's a platform for like-minded people to meet and then also share ideas. And I'm sure they'd love to have you interview them or kind of participate. And, there's so many people to learn from. And it's always great fun to tap into these networks and speak to people.
Listen, as we're wrapping up and final words, first of all, thank you. And you're in charge of connecting me, and I would love to interview you.
I will. Okay.
It's always interesting. And I'm now traveling the world with my upcoming book, which is called Fuck the Slides. So I'm always here to help people tell a better story about how to pitch their ideas. So I'll be happy to talk to them. Where can people follow you? Are you on social media in any way that they can follow you?
I'm on LinkedIn, and I do have a website.
So what's your LinkedIn handle?
It's Robert Leitz, Leitz. That's me, and the company is called Iolite Capital, IOLITE Capital.
That'd be amazing. Final words before we wrap up?
No, Nir, it was just great to be here. And then to the audience who is listening to this, if this got you excited and curious, please reach out. And I'm always happy to, just connect with interested and like-minded people. Would be a pleasure.
My friends, we're wrapping up another episode of Europreneur, the podcast for EO Europe. I'm always learning something. It's unbelievable to me. Every 40, 45 minutes is a new learning curve for me. Thank you very much, Robert. I feel, first of all, I have to read more. It's not enough. And I'll probably reach out to you. I have some different questions, and maybe we'll do a follow-up in a few months, if that's cool with you.
Awesome. Perfect.
My friends, I'll see you next time. I'm Nir Zavaro. Stay safe and don't waste your money, huh? Invest it smartly.